Good morning, Sunday morning, SMF Street traders and our foreign traders around the world. Welcome. And all people that are non-U.S. citizens qualify to be on SMF Street. You qualify to be in the SMF Street trading division. And that's where you're using our platform and you're engaging and you're making a living. This is a $1,900 call. That was a breakout. That's this call chart right here. And when we called the bottom of the market, it was time to be on the call side. These contracts here, I'm going to show everyone here exactly where they are. I'm going to show you where the low was. This was at the beginning of that September move on the call side of the market. It was the last day of August. And the call side in August from here, when we were short, this call side just got bam right down here to $11.43, and that was the end of the August move. We re-leveraged, got long the call at $11.43, all the way back up here to $80 is the high, $81.50. That's a lot of money. If you only had 10 contracts, say you paid $12 for them down here at the bottom as a volatility trade against that short. Okay, because these at the time, this same put option, the $1,900 put, when the markets went higher, you lost. These were up here. Look at this pricing here, folks. This is $128 on the high of that $1,900 put, and we close at $1,955. But now look down here. Look down here. The low was $22 down here. The high was $40.73. Remember that this is out of the money put by $55, out of the money $1,900 put. On the other side, this contract as premium is very depreciated, not depreciated, but totally deflated. So basically, when the calls lost all their value, the calls got money back again. Pretty nice move. So there was a great trade here on the 1900 put when we were selling off in August. It was a great trade down there at the time. This is where it was, $22, and it went to all the way up here to the top to about, well, actually it was about 60 some dollars over here where the move happened, but it made 100% profit. Went darn near to $140, $139 and some change. So basically, I want you to know that that's the deflated $1,900 put. That's out of the money. But this deep $1,900 call on the index is well in the money. And when they get top-ended inflated, they do come down like they did here. And they go all the way back up. There will be a time that we're just watching where we get so inflated over here, and this side is a premium trade on an entry for an exit, because it is. We already have all of the other put options right here, SMF Street. I will be giving you the live trades on the NASDAQ 100. And remember, they have upside resistances on the NASDAQ 100 charts. So the reality is you're going to look at those weekly charts that we did along with this, and we're going to be watching the $1,970 put in the money, which is totally deflated, okay, because we're going to be watching that one there. We're also going to be watching in the money $2,000 call over here as well. And we can see here on the, that's the 2,000 put, I mean, and it's down at the bottom. So that 2,000 put is one that we're watching. And we're going to watch, because if we travel up on the indexes, they're going to take premium out of here. And we know where to price the premium based on that. So if the NASDAQ 100 breaks up to the 1975 handle, that means they're going to take a lot more premium out of here, and it'll be even that more deflated where we would cap that price automatically in our setup procedures using the SMF Direct Access platform. That's not this platform. That's the SMF trading platform. So we're going to know how to price this, SMF Street. Because if we go higher in the NASDAQ 100, and we'll find out on Monday, we're going to come down in premium. I will price this market here. I will also price this market here. And on the same token, I will price the other side. What you have here is a $2,000 call that is about $45 out of the money. The NASDAQ closed at 1955. You have come all the way up off of this bottom. At one time, the low was 1020, and now we're up here, but we're inflated up in here. That's in the money $2,000 call. Well, we know that if we lose value here, that the put side pays, and we'll be doing all of the mechanical pricing. We're going to be watching that bloated call right there. The other one we're looking at is this 1975 call. In the same 3-week period, we had a low, and we're all the way up here to the highs. And this is where that 3-week move into the inflated price. That's up and out of the money, $1975 call, SMF Street. But what do you look at? You're not here. You don't use all that day trading option stuff. That doesn't work for you. What works for you is imbalanced pricing mechanisms, imbalanced pricing controls. And we're top-ended up on the call side, and we're getting, you know, pretty well down. So here's a $1975 call, but then look at the $1975 put. I will give prices now out on the video after this video is over. So we're done with the video.